Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors, and I am joined, as always, by the wonderful, talented, and amazing David Kroll of the one and only Mortgage Network. And we are here to discuss all things where your money matters. So every week we discuss a little bit of what's going on with the markets. This week is no different, even though we're sort of just repeating ourselves again, because we are just seeing this market continue to sort of step towards the Dow 20,000, and every day it's little teeny paper cuts in a positive way, I guess, as we get closer and closer to that number. And financials are leading the way. Oil's been strong. A lot of strength within the markets, within the Dow, within the S&P. So it's just been a very positive couple of weeks, 5 weeks, I guess we're on now. So obviously, if you're looking at your 401k going into the end of the year, or looking at your investments going into the end of the year, seeing interest rates starting to move up slightly, hopefully generating a little bit more income on your portfolios, it's all extremely positive. So we're pretty excited. Chasing at this point is probably a little dangerous, but by and large, hopefully you've been in the market, and hopefully you're looking at some fantastic returns on your portfolio going into the end of the new year, or the end of the year and starting the new year. The other thing that we often talk about is interest rates, specifically as it relates to real estate, and that is a little more ambiguous. It's a little bit tougher to see where those prices are going, especially in light of the various natural disasters that we've had and with interest rates moving up. So we thought we'd focus a little bit more today on our local markets and what we're seeing in terms of investment and interest rates, and what the impact that's having on your other investments, perhaps in real estate, your home, or other real estate. So what you
Super. Yes. Big topic. Today is Friday the today is Wednesday the 21st. And I don't know when this airs, but this morning the national home builders numbers came out, and the real estate numbers came out, and there are 5.6 million new homes. This is the highest increase. That's the pace. This is the highest rate of increase in new home purchase for 9 years.
Wow.
Since 2007. Almost 10 years since 2000. It would be February of 2007. 2007. There's a robust market expressing itself. We've seen the same thing here in Hilton Head in the last couple of months. We were expecting the disrupted market in interest rates. As the stock market goes up, often the bond market goes down, usually, which forces interest rates up. We've talked about that equation.
It's actually happening that way now.
And it's actually happening.
Nearly 10 years it had been going the other way. There were 100% correlation between the two, which is not the way it's supposed to be.
Which is very confusing.
Yeah.
And so we've seen interest rates sprint up during the 5 or 6 week period since the election, just as we've seen the stock market move up in that same 5 or 6 weeks.
Well, and just to as a number, when we were going into the election, we were looking at a 10-year bond at somewhere around 1.7 or 1.8. Now we're looking at the 10-year about 2.55. So in percentage terms, that's up
0.75%. It's almost 40.
Almost half. Yeah.
Almost half.
Yeah, that's
40%.
If you consider the cost of your credit card debt going up by half, you'd probably freak out a little bit. So it's extremely relatively low, but relative to where it was 5-6 weeks ago,
it's the same as gasoline going from $2 a gallon to $2.80 or $2.90 a gallon. You would certainly notice that.
Right.
So, but anyway, the interest rates have been shooting up. We thought this was going to be disruptive to the market. What we have instead found is just consistent with the national numbers. The number of new inquiries and the number of people pulling the trigger in the local market has been very consistent and very strong throughout November and into December. We had the big disruption, as we're all still living through to some extent, with Hurricane Matthew, which upset the equilibrium of the market. It basically canceled all appointments of incoming buyers, and simultaneously it disrupted the lives of people who already live here and might have been moving or buying. So kind of, sort of, everything went on hold for about 4 weeks. Then to get started and on stream again, took another 2 or 3 weeks. But we are
That's
definitely...
really amazing. That's a short
Yeah.
period of time.
Yeah, and we did an amazing job. We Mortgage Network have noticed an unexpectedly strong market coming out of Matthew. All of our realtor friends are saying that we should expect a very strong market in March, April, May of this year, maybe starting early in February of this year. January probably.
And
slow.
what are they attributing that to?
That there's economic optimism. Borrowers don't want to be left behind. My life's experience in the business has been this oddity, which is that I, along with everybody else, never managed to buy at the bottom and sell at
Join
the
the
top.
club, right?
I've never been able to do that. So the time to have a mortgage, if you've been listening to Money Matters, the time to get that best of all mortgages was any time in the last 3 years. But of course, any of you who didn't now will have to pay almost 0.75% more. And guess what? You're all rushing to get mortgages.
Right.
Because
We don't want to pay 1.5% more.
because you don't want to pay 1.5% more. So
Right.
what happens is it's just interesting market psychology. What happens is that when you get a bit of a fright, you become more decisive. And it's out there. The winds are out there. Rates are going up. They have already gone up from 3.5 to 4.25. They might go up a little bit more. However, I'll defer to Emily here. There might also be a first quarter of 2017 correction in the stock market, and conversely, a correction in the bond market, which will bring rates maybe down a little bit.
Well, what that could be caused by anything, and it certainly doesn't say anything about all of 2017, because in the beginning of 2016, we had, well, I think we had 5 devastatingly bad days in a row, and I believe that was China. Is that, if I'm getting all the rest of this last year confused? But that was largely driven by China and concern over
Concern over its rate of growth.
Right.
Yes.
And so we could see the same thing right now, whether it be driven by China or Russia, but probably more likely driven by Europe with the various ISIS attacks, concerns about the liquidity of the Italian banks that could carry over to our banks, which have absolutely been doing phenomenally in the stock market. So it would likely be driven by something like that, or just the need to take some profits. I mean, one thing, and we talked about this a little last week, is
profit exuberance in the last 4 elections. This is a completely random fact, completely random, believe me, non-analytic. In the last 4 elections, there's been a post-election or a pre-election rise in the stock market from the time that the primaries end and there's a president, and from the time the election ends.
the only time that didn't happen was
that
with the Bush. Wasn't that with the Bush? What was the Bush Gore that was tight? That was the only time that didn't happen.
Right, but it did. But for the most part, what happens is the market goes up, anticipating the inauguration of the new president, and then everybody takes profits after January 20th in February, March, April of that inaugural year.
Right.
And the likelihood, it's what's it worth? The likelihood is that this sprint has been so strong that there's going to be some profit taking.
When there's a thought that because of the expectation that taxes are going to go down, that there'll be profit taking, that they'll wait until next year for that profit taking, so that they will experience the better cap gains rates, the better income tax rates, all that stuff.
So it's interesting.
We shall wait and see.
So I didn't quite get to what's the condition of the local real estate market. I'll just touch on that, and then we'll hit it heavier in the second half.
Okay.
What we're seeing is an extremely strong tightening market in the $400,000 to $650,000 range on Hilton Head, in the $200,000 to $450,000, or really the $200,000 to $650,000 range in the Bluffton market. The rest of the market has some very interesting things happening, both condominiums and the $1 million and up market, and we'll talk about that in the second half.
Okay, please stick with us. We'll be right back with more Money Matters.